Some investors spend years trying to beat the market while others invest in the entire market and do nothing. Two totally different mindsets, yet both claim to be the smart way to build wealth. So who is actually right? In this video, we are diving into one of the biggest debates in investing: active versus passive investing. We will break down the real difference between the two, look at what the data says, and find out which strategy truly wins in the long run. Welcome to Martic Finance, where we explain investing concepts in a simple way. This is not financial advice, so always do your own research before investing. Active investing is all about trying to beat the market. That means earning higher returns than the overall market, usually measured by the S&P 500, which tracks the 500 largest companies in the United States. If the S&P 500 goes up 8% in a year, an active investor aims for 10 or 12%. Instead of buying and holding an index fund, active investors pick individual stocks, bonds or funds they believe will perform better. To do this, they rely on research data and timing. They study company reports, analyze financial trends, and track market signals. There are a few common ways people practice active investing. One is stock picking, buying and selling shares of companies you think will do better than average. For example, an investor might choose a company with strong fundamentals, good revenue growth, low debt, and steady profits, but whose stock price is still undervalued. The idea is that the market will eventually recognize the true value, and the price will rise. Another approach is to focus on a specific sector like renewable energy technology or healthcare. If you do not want to pick stocks yourself, you can invest in actively managed mutual funds where a professional manager makes decisions for you. They study the data, track movements, and adjust the fund portfolio to outperform the market. Another option is active exchange-traded funds known as ETFs. They operate like mutual funds but trade throughout the day on the stock market. Active investing offers advantages. There is potential for higher returns if decisions are smart. It also gives flexibility, allowing investors to respond quickly to changes and find opportunities. However, there are clear downsides. Beating the market consistently is extremely difficult. Active funds charge high fees, often around 1% or more per year, which reduces long-term growth. It also takes time, effort, and discipline to manage emotions and research companies. Passive investing takes the opposite approach. Instead of trying to beat the market, passive investors aim to match it. This is usually done through index funds or ETFs that track an entire market index, like the S&P 500. When you invest in these funds, you are buying small pieces of hundreds or thousands of companies at once. The idea is simple: do not try to pick the winners, own them all. Passive investing has strong advantages. It is low cost because there is no expensive fund manager. Index funds and ETFs usually charge between 0.03 and 0.20% annually, which is very low. It is also simple and time efficient. You do not need to research companies or watch the market all the time. Historically, passive investing has delivered strong long-term performance because markets tend to grow over time. It is also easier emotionally because you are not constantly reacting to short-term price moves. The downsides are limited. You can only match the market, not beat it. The strategy can feel boring since it involves little excitement, and you are still exposed to market crashes. When the market drops, your portfolio drops too. Now, how do active and passive investing compare in reality? The data tells the truth. According to S&P indices versus active, around 80 to 90% of active funds fail to beat their benchmark. That means most professionals with research teams still earn less than simple index funds. One famous example came from Warren Buffett. In 2008, he made a 10-year bet against hedge funds. He believed that a simple S&P 500 index fund would perform better. After 10 years, the index fund earned about 7% a year, while the hedge funds made less than 3%. Even top experts could not beat the passive approach. Studies also show that most individual investors underperform the market due to emotional decisions. They buy when prices rise and sell when prices fall, which lowers their returns. Active investing can make sense for people with deep knowledge, time, and discipline. It can work for those who focus on smaller companies or use special tools, but overall, passive investing wins in most cases. Low costs, diversification, and compounding make it hard for even professionals to outperform it. Passive investing also builds good habits, steady contributions, and long-term consistency. Still, you can combine both strategies. If you enjoy researching companies or following specific sectors, you can allocate a small portion of your portfolio to active ideas for learning and excitement. That is all for today. If you found this helpful, make sure to like and subscribe for more financial lessons. Thank you for watching and see you in the next video.